Inventory valuation methods. Let's assume that the business bought 5 units of product X for $10 each. The business didn't have any units in its warehouse before this purchase. If the company sold 3 units, there isn't any problem in valuing them as all of the units are for $10 each. The cost of goods sold is $30 for the 3 units sold. Now let's assume that before the company sold these 3 units, it bought another 5 similar units but for $12 each. Now if the business sold 3 units, how would it calculate the cost of goods sold? It all depends on the inventory valuation method used. There are several valuation methods. Let's start with the first one. Specific identification method. This method is used if the business can identify the cost of each unit. So if the business sold 2 units that cost $10 each and 1 unit that cost $12 each, the cost will be $32. On the other hand, if the warehouse keeper shipped a different mix of units, for example, 2 units that cost $12 each and 1 unit that cost $10 each, then the cost of goods sold will be $34. It all depends on the units shipped and eventually sold. As you may appreciate, it would take enormous effort to identify and match the items shipped with the value of the items purchased, especially when there is a constant movement of inventory coming in and going out. That is why this method is used when the product could be identified. And it is expensive, for example, precious jewelry, pieces of art, etc.